Hi, folks. I'm Tom Ferguson. I'm simply the chair of this event. I'm not going to try to play talk show host or a panelist. I just want to explain that actually this is not quite the panel that we were thinking of having. And that was essentially when I was talking to Rob Johnson about what we might do at INET. What could we really do that would be really different from other international conferences? And I just sort of said, well, you know what, I think what we really need to do is to invite the Confidence Fairy to show up and give a talk. And those of you who've been reading Paul Krugman will understand immediately who the Confidence Fairy is. Now, my problem was that I didn't know whether it was a he or a she or an it, and in a university we're sensitive to these things. So I started writing some letters to find the Confidence Fairy. And it was hard because nobody knew, this person had never been seen. So I started with the Harvard Government Department, which seems to know that this person exists and does wonderful things. But then they confessed they'd never actually seen him, except they'd heard it was in small countries. And so I wrote some notes around to various small countries, and I knew they were small. Some people were saying, you know, there was a question this morning about whether the Confidence Fairy ever appears in, was it really important that the country was small? Try the square miles of all those countries on Alice Sina's list, and you'll discover something really interesting. The conclusion, the Confidence Fairy has never been seen in a large country, and never when the world is in depression or a great recession. At any rate, I couldn't get anything from a small country that was real, so finally I wrote the Bundesbank. And they sent me back a little note saying, we'll meet you at midnight at the S-Bahn out here at Unter den Linden. So I went out and I said, okay, tell me where the Confidence Fairy is. And they said, all right, you've seen, the spokesperson, who had sort of kept their face veiled, said, well, we're going to confess that the Confidence Fairy doesn't really exist. We're going to just tell you it's sort of like a reverse Santa Claus, which doesn't exist either. But what we're really scared of, and the reason we tell you that the Confidence Fairy will work, is we're really afraid of the ghost of inflation. And that's everywhere. And I said, wait a minute, we've heard about inflation. People were saying all through the 1930s in the United States that inflation was just around the corner. And ever since the great recession started, we've had a huge crowd of people in the United States and elsewhere saying inflation's just around the corner, and nobody can find inflation, really, in any degree. So I went back to Rob and I said, hey, well, I don't think we're going to get the Confidence Fairy, but we are right within the shadow of the Brandenburg Gate. And you know, that should be a reminder that there are a lot worse things than debt that can happen to countries. And so we decided to do this panel on the challenge of deleveraging and debt overhang, the politics and economics of restructuring. And so I will simply do the speakers in the order in which they're on the program. And the first one is Anat Admati from Stanford.
Thank you. I appreciate being here. I'm going to talk about debt overhang, and I'm going to start by trying to kind of define the term. Debt, which we heard is a big problem, and I will concur with that, starting with Bill White yesterday and then this morning. Once debt is taken, it is a burden on the borrower. It's a hard legal commitment that would not go away. Something has to be done about debt. Either it has to be paid, it has to be restructured, or the borrower defaults. And that, I'm talking for the first few slides about any kind of borrower, be it household, government, or corporations. So what happens when the debt is there is it might, if there's a lot of it, affect investment. And that's the debt overhang effect in general, that any new funds, first of all, the debt has to be paid and then or restructured, and any new funds have to be raised at a price that reflects where we are right now. And that's the problem. And that's the potential inefficiency of debt overhang, that the debt, once taken, becomes a problem. So distressed borrowers become problematic entities in this world, and that again applies to households underwater, to corporations in distress or zombies, and to countries which borrowed a lot. So we have this crisis right now. Everybody borrowed too much, it seems. Households borrowed too much in some countries, governments, obviously, and banks. And I am going to focus on banks. Debt overhang is among the many inefficiencies that are associated with high leverage. And the word leverage is used especially in the context of corporate finance, because I am going to focus on the fact that banks are corporations. Some of them used to be partnerships, but we're going to talk about corporate finance and the insights there. So there are two types of questions once you have debt. First of all, the debt's already been taken, and what do you do now? So deleveraging, indeed, or reducing leverage in general. How do you reduce leverage? What happens to good investments? When can they resume? And the political question, who controls this process? Restructuring of mortgages, restructuring of country debt, and the deleveraging of banks. Who controls this process? The creditors, the borrowers, the governments, other governments. That's the political question about restructuring. And then there is a long-run question, which I want to talk about, because I think we have to keep our eye on the ball, especially when it comes to bank borrowing, which is, what should it be, and how should we prevent the banks from getting distressed like this in the future? Can we stop them from lending too much? Because some of the borrowing problems that we have are because every borrowing transaction has a lender. And to the governments and to the households, the banks may have lent too much. And how do you make the governments make fiscal decisions that are sound? That's a problem that we will not discuss. But in highlight here is, what is the role of bank capital regulation, and what's the politics of financial reform, regulation, and restructuring? So here's the focus on bank and capital regulations. The banks are at the center of the crisis of 2007, 2008, and the crisis right now. Some people want to call it other things, but we've already had mentioned that this is a bank crisis. The banks that we have, some of them are ever larger, universal. Some of them are too big to fail, SIFIs, call them what you want, especially in the UK, US, and Europe. We have these SIFIs. They are highly leveraged, and particularly if you look at their total balance sheets and not at these creatures called capital to risk-weighted assets. That's where a lot of risk gets hidden, and that's where a lot of the puzzles about why they lend too much also lie, such as zero risk weights to sovereign debt. Some banks are insolvent right now. The word zombie was already mentioned, and it's an issue of whether you recognize it or not. We sometimes recognize it a bit too late, and we sometimes drag along insolvent banks, which has been done in the savings and loan crisis and in Japan, and is not a good thing. So that's one of the challenges, is to recognize when banks are insolvent and to figure out how to bring them to health, not maybe through the cheap carry trades that they are being offered right now. So the excessive borrowing, indeed, as I said, involved potentially excessive lending by the banks and their own excessive leverage, and they are intertwined. There was less skin in the game for the bank, lower credit standards for their lending to households and to countries. They wanted to innovate to hide their leverage, such as creating AAA securities and lending to governments, and as a result distorted what the lending that we need them to do, which is small, medium enterprises, where they play a role in the funding of the real economy. So the structure of the regulation had something to do with what we've seen. And this is something that, unfortunately, has not completely been corrected by current regulation. Historical facts about bank capital have already been mentioned in the last session. We don't remember those days, none of us, but it wasn't always like this, that banks had such leverage that they have right now. And in fact, here's a picture just starting in the late 19th century, but if you go even farther back, you will see this line coming down. This is the equity to total assets. And 100 years ago, in the bad old days, it was in the 20% of total balance sheets, numbers that one would be called crazy to mention right now. And I go back to the point that was mentioned last session, bank equity did not even have limited liability until deposit insurance was created. And therefore, the downside was borne by the same people who have access to the upside. So equity on the bank's balance sheet is often forgotten because it's considered that they just borrow and lend, but it is there, and it does take that spread, and so do the managers that are there, also mentioned in the last session, and their incentives. So what we see here, just to realize what we are talking about, the risk-weighted assets of banks have not grown dramatically prior to the crisis, but their assets have. And that shows you how banks in Europe could have gotten to be 5 times larger than in assets than the risk-weighted assets. And so that's hiding a lot of what is going on. And in the various other graphs, and I hope this is posted, you can see the trend towards more trading and less lending by these banks. And so more activities that is not clear are benefiting the economy. What you get with high leverage is the leveraging spiral when loss sets in and you're highly leveraged in order to recover your equity. And we've seen this in the crisis. You need to sell in a hurry, and that creates pressure on asset markets, and that sets out fire sales and stuff that we have seen in the crisis. So it's a highly volatile thing to be at. So the question is, why don't we attack it? The whole fragility of this system. Fragility consists of both the high leverage, the short-term nature of the debt, and the interconnectedness of these institutions. So fundamentally, they have excessive and incredibly high maturity transformation, short-term borrowing, long-term investing, and that creates a lot of liquidity problems. So once you have distress and insolvency, the default is very, very costly and disruptive, and this is why we end up with too big to fail banks, is we cannot stand to let them fail. We've tried this with Lehman, it didn't work out that well, and that makes us worse off right now in the sense of credibly committing not to do it next time a situation arises. Going back, it creates enormous distortions and moral hazard. So then you say we want to impose losses on debt holders, and we see how hard that is to do. Once the promise has been made, it's not going to be given up lightly. And we saw this with Greece, and any kind of debt restructuring does not happen quickly. So any kind of resolution is very complicated. Now, liquidity problems don't usually happen out of the blue, so, and if they happen, they are easier to solve if you don't have solvency concerns, but if you have solvency concerns, they can happen fast and be more costly to solve. So this is a big problem, but more equity will get better incentives as well. Why not then? The mantra in banking is that equity is expensive, and this is just one of those religious beliefs that is completely wrong and misguided in the context that's relevant here. We have to ask, why is equity expensive? To whom is it expensive? Does more equity prevent banks from doing things that they would do? Do their costs increase? And if so, why? Given that there are so many benefits to more equity for banks, what is it that's the trade-off, really? Is there a relevant trade-off? And let me give you the bottom line now, because I might not get to it. Bank equity is expensive for banks. For us, it's the biggest bargain there is in financial regulation. There is no better bargain than doing that. It cuts nothing good that happened. It doesn't increase any costs. It has only benefit as far as the eye can see from where we are right now. I'm not talking about banks fully funded with equity. I'm talking about banks funded with 20 to 30% equity. And somebody is yet to explain to me why not, with some relevant reasons. The basic smell test I will give you, rather than going through all the stuff that's being said here, is if equity is expensive, why do we see it used so much by corporations that are not regulated not to have debt? So it could be easy for Apple or for any other corporations to borrow more than they do. and yet they don't. So you have to ask yourself, if equity is expensive, then why is Apple being so stupid and doesn't borrow at the cheap rate that they can borrow? So obviously something is going on here, okay? Apple could do a leverage restructuring and they wouldn't even notice it, and their creditors won't even worry. It's probably the first $10 billion that Apple borrows is probably the most riskless asset there is in this world. So, so there is a question here that you have to step out and ask yourself, why are the banks loving leverage so much, and why doesn't the rest of the world, Silicon Valley where I come from, use so much debt as they do? Why can't corporations thrive and grow with equity? And why banks refuse to do it, even though they could? The standard funding considerations are the following. Debt has a tax advantage for everybody. Everybody can pay a little bit less taxes if they borrow. It's a really stupid way to structure taxes, but that's the tax code that we somehow have. And income was defined excluding interest expenses, and that gives an immediate bias towards debt funding, which is, for some reason, considered God-given, even though it's human beings that created this code, and human beings can change this code because it doesn't work very well, especially for banks. On the margin, giving more incentives for polluting leverage. But what stops other corporations from borrowing too much is that the debt has this burden. The debt has a deadweight cost of default, not the fact of default, because that's just dividing the risks and the returns that are there that were promised in advance, but the extra cost of default, which are borne by those investors who are lending the bank, the corporation. And moreover, there are agency costs of debt, which distort the decisions of a leveraged corporation to take excessive risk that benefit equity at the expense of debt, to not take advantage of beneficial investments because their benefits would accrue to existing debt. That's a debt overhang, and a resistance to reducing leverage, even if it benefits the entire corporation by saving, for example, on bankruptcy costs. So what you have is a situation in which agency costs are considered by creditors of most companies, and they will either increase the cost of debt or lead them to write a lot of covenants that restrict the corporations, which is why most corporations do not borrow anywhere near banks. For banks, everything is different because the banks don't feel the burden of debt as much. Their creditors are not as worried as the creditors of other companies, and they have deposits, and they are insured, and then they have other liabilities, many of which are in the safety net either now or believed to be in the safety net by those creditors, and somehow these creditors are allowing them to keep borrowing, which most other creditors would not, and to pay dividends and all of that. They don't bear their own resolution costs, even if the industry is assessed their moral hazard problems. They have ROE compensation that completely distorts the preferences of the managers. In regulation discussion, we have to focus on social costs, not on private costs. So if banks find debt cheap, but the reason is because it's being subsidized by us, then we're doing a paradoxical thing of subsidizing something that actually pollutes the system and creates distortions. So the lost subsidies are not social costs. Even if they pay more taxes, not a social cost. If we withdraw guarantees that lower their borrowing costs, that's not a cost to us. Here is the picture. Banks can raise money by equity or by debt. Sure enough, they have some deposits built in, so that's fine. And here's the river. The more debt, the more systemic risk they create. What do? We subsidize debt. We see them choose a lot of debt and very little equity and pollute a lot. What happens? Banker stock price go up. Bankers are happy. Do they reduce the loan costs? It's not clear. They pass the subsidies on. They certainly take off the top quite a bit. What's the picture? The picture is the private situation for banks is debt is best. The public consideration is equity after deposits and all the stuff that they can do is already there, including some debt. The marginal equity dollar is cheap for society. if banks use it. But the big challenge is that they don't have the same preference as us, and they will kick and scream. The tax subsidy can be neutralized, so there are many ways to do that. The bailouts and the safety net is harder to take away. It was there for a good reason, and we want to be there if necessary, but how do you reduce the distortive impact of it? It's hard to charge for guarantees. It's hard to tax in the right way. It'll always be a step ahead of you. Equity is the preventative approach. It basically moves the downside risk to the private market, to the place where it belongs. How much equity? Basel has ridiculously low numbers. Basel was not supported by sound science. I'm saying it here because I've looked into it. It's not focused on the right questions. It doesn't give the right answers. And so the levels and the structure of this regulation is flawed. The implementation issues are big. So I'm going back to what to do now. If we even want to move to Basel, what's going on? Again, credit crunches will happen and all of that. Let's remind ourselves the following. Credit crunches happen because of too much debt, not too much equity. The transition is a different story. So we have to keep asking ourselves, how do we transition? Well, there's DeLeveraging through asset sales, there's just plain recapitalization, and there is asset expansion through equity. In principle, all of those will get a bank better capitalized. If you give a bank a ratio, it'll do what it wants to do. It'll do all kinds of things, and it might sell assets, some of which might not be bad. But the shareholders, it should be emphasized, would not like this because they would lose subsidies potentially. The leverage that they have is addictive in the sense that when they reduce it, they take away some downside risk. That is even true without subsidies from the creditors or whoever guarantees the credit that they otherwise have. And so they'll get diluted in the process, but it is a very, very good cause. This is an addiction that will not be cured by itself. This means that we must regulate this transition. They will choose to borrow anytime you let them. So the resistance is based entirely on private costs, and the issue is how do we manage the transition. The first, and the risk weights are a problem for lending already. And if you talk on asset sales, there's a big topic which I don't have time to go into. What does that have to do with lending restrictions? With respect to lending, where we're going to, which is a much better capitalized banking system, if I had my way, would be banks that lend better, that make better lending decisions, more sound basic lending decisions. They have money to lend. This is not about reserves. This is about funding. So the risk weights themselves discourage lending. ROE compensation discourage lending that we need. The key to the transition is to maintain the capital that's there. The worst to do is to allow equity payouts, cash to come out of the banks. And therefore, allowing dividends is flawed. And a creative approach was used by the Financial Policy Committee in the Bank of England, telling banks to pay bonuses and pay salaries with new equity, not cash. Then they have money to lend, and then it's an issue of whether they'll have the incentives, as was said. Maybe managers should be getting extra liability. That might help. There are other arguments, and they go in the political debate, level playing field, flawed argument. Shadow banking is a concern of enforcement, and you have to tackle it anyway. So that's just part of the scare and the manipulation that happens on this space. I'll be happy to talk about this later. My summary is we must reform the banking system, and reforming the funding model of the banks rather than try to get in there and tell them even what to do and all the Volcker and other things, which I'm all in favor of all of these things. But this one is a no-brainer, cost-efficient way to do it. The system is excessively fragile. It doesn't have any use or purpose, and it's not essential that it remains that way. Regulation is critical. It won't happen by itself. The private agents have no incentive to take account of their externality. Much higher equity requirements are essential. Calibrating for risk, we have to find a better way. And the resistance from bankers is entirely based on private consideration, and they have no position and nothing that they've said that is about what's good for the economy. They would lend if it works for them to lend, and we just have to give them incentives, as was said before. And this is based on two papers that I have some copies of, written a year ago, and one just finished specifically on that overhang, and a lot of other stuff is on this website. Thank you.